Welcome back to Total Money Management. We've made it. We're part 4 of 4, and we're 4 weeks later.
We're at the finale.
We are.
Hoping you're still with us.
Yeah, well, I think it's been. I mean, I've found it interesting. Read it. A lot of this stuff you know, but you don't look at it for months or years. So it's interesting to run through again. But in this one, we just want to talk a little bit more about the stocks versus property. Give people some real questions to ask themselves.
Yeah. Well, that's why we talked in the last one about the equity risk premium, which is essentially a flashy name for bonds are paying 4 and I want 10. Okay, well, you've got to find something that earns an extra 6.
Exactly, yeah. So by the end of this, we should have a list of 2 or 3 things for someone to ask themselves when they're looking at an investment, whether it's stocks, property, art, cars, whatever.
Yep.
So what have we got here? Value, not price.
Yeah, I just, again, harping on price and value, but what I wanted to show was when I put these together, property was really exploding, and what I want to show people is, as I've said before, I'm not against property, but I look at it as an investor and say there's a lot of risk because I'm leveraging up interest rates to get a capital gain. Okay? And so what I'm showing there also with the little chart on the left there is that house prices have gone gangbusters since about 1985. We talked about it from 2000. The reason why is because it went really big in 2000, and we talked about that in Property Problems, our podcast special, previous one. So the argument is, but it's all on fundamentals, right? So it's population growth and it's, all these sort of things. What I wanted to show with that chart is it's not, because population growth hasn't grown that much over 25 years. Now, the last 5, you can get on your high horse. But the point I'm trying to prove is it's not always about fundamentals, right? It's always about irrational exuberance.
Yeah. Population growth has actually been quite steady.
Yes.
And that's normal for countries, but prices.
And Jacob, that's what you want to calculate, right? Don't calculate interest rates staying low for 20 years, right? Calculate the long-term average. Now, they might be low at the moment or they might be high. That's okay, but will they stay that way? I don't know. All right, well, if you don't know, use the base rate as your base figure.
And if it's better than that, you're
good. Great. If it's worse than that, okay, you might need to have a little bit of a think about the investment. Okay. And again, not just property, but stocks. Okay. Art, cars, everything. And the one on the right there, I'm just showing you that property also spends a lot of time going nowhere.
Yeah.
Not just stocks. Okay.
27 years, 21 years, 11, 13.
Yeah. Well, if you add those up, I think it comes to 48, 59, 65, 75, 80, about 85 years. So 85 years out of about 140, more than 50%, prices are going nowhere.
Well, even more recently, you've got 7 years in the 90s and you've got 4 years in the late 2010, 2014.
Yeah. And people will say, but if you hold through those times, you do fine. It's like, but can you hold through those times? Not everybody can, right? They lose their job. They have kids, a whole raft of reasons.
They sell because they're emotional and scared. They think it's going to keep going down. Like that's usually what happens.
Absolutely. So I just wanted to talk a little bit about interest rates. So again, low interest rates make things look more appealing. Right. And this is where I wrote this a couple of years ago, but people are really now starting to get a bit of pain with interest rates, right? Because they've tripled. So low interest rates send a different signal than higher interest rates and can change the value not only of real estate, but all sorts of investments, right? Companies borrowing money, right? That affects their earnings, affects their stock value, right? To earn $100,000 in income from $1 million, you got to get a 10% return. But you have interest payments, right? A lower interest rate raises the income, thereby making the investment appear more attractive, okay? But it also makes marginal properties or companies more attractive, possibly luring people to take much more risk, right? Again, you look at it and go, man, this property is great value, right? But then you look at it and say, but what happens if interest rates double? Oh, well, then it's not really good and I might struggle. Okay.
Oh, they go, no, it's not going to double or good. Don't think about that. Don't be so negative.
Well, that's what happened in COVID, right? What if you were happy with a 5% return on the property above? You'd be willing to pay $2 million for the same property, right? Low rates simply means some investors are willing to pay a higher purchase price for the asset's income and potential capital returns, right? Oh man, everyone's killing it in property, right? So you bolt into property and you pay a higher price, right? Same with stocks. Who cares if the dividend's 2%? Nvidia's going to double in a year, right? Because of the cycles, the quote-unquote profit comes from either speculation, right, which is the short-term rise in the capital gain, right, or investing, which is the long-term growth in the income component, okay? Bubbles are where speculators seek a quick capital gain rather than investors who seek long-term income. That's what Buffett talks about, right? Buffett says, you want lower prices, right? Well, this is why I say, nobody in Australia is going, oh, man, I'd love the property prices to fall a lot, because they're all in it for the capital gain, right? Because then the investment yield is awful without negative gearing, right? You imagine if the government said, listen, no more tax breaks. You'd look at it and go, well, this investment sucks.
It doesn't make sense to me.
Right? That's where you look at it and say, well, maybe it's not a great investment if you've got to be lured into it with tax breaks, right? Which is what is happening.
And it's,
right?
for political reasons as well.
Absolutely.
Keep them in.
Absolutely. Okay, stocks versus property. We talked about this a while ago in a special. But what I'm trying to say to people is both of them have a place in your portfolio. It really just depends on the expected returns, right? If property is really, grandma dies and says, oh, you can have this place for $200,000 and it's worth $500,000. Well, God, by all means, sell your stock portfolio and get into property, right? Because that's where the returns will be. But again, saying it always depends on doing those figures, right? Okay, well, that's great, Grandma, but how much is this sucker going to cost me to upkeep? Oh, well, you're going to have to paint it and re-roof it. Oh, okay, well, there's $100,000. Okay, now the property's really worth $300,000, costing me $300,000, right? The tenant's been in it and, they've got a lease to where they pay $50 a week for 10 years. Okay, right? That's what I mean. You've got to be aware of those little idiosyncratic risk, right? What's the risk attached to that property alone? What's the risk attached to that stock? Right? Other than the general market risk or interest rate risk.
Yeah, you're not buying 400 properties and...
Yes, you're buying a single asset, and that's where you've got to be a little bit particular.
Yeah, I mean, they both have a place in someone's portfolio. Like we don't hate property. We always
absolutely.
Sometimes it's the right time to buy property. Sometimes it's the right time to buy stocks.
Yes, we're just saying to people, just be level-headed when you buy both. So, when everybody's jumping at Nvidia, you need to look at it and say, okay, am I going to speculate in this sucker for 6 months? How much am I going to win? How much am I going to lose? Right? You've got to do it rationally. So the other one you hear in property is buying and selling in the same market, right? Oh, if you do that, you'll be all right. No, that's not right. Okay. If you sell your property for more than it's worth, you're probably going to buy in a property that's more than it's worth.
Yeah, especially if you only have one or two.
Yeah. Well, and the other thing, as I say, is if it's a PPR, well, you sell your property. Well, okay, what do? Be homeless?
Yeah.
Or do you rent? Well, most people go, I want to scale up, right? So we bought it for $1 million. We sold it for 1.4. We've got some equity. Now we're going to go and buy something for 2. Right? And it's like, yeah, okay, but make sure the 2 stays at 2 and it doesn't go back to 1.5.
Yeah, or they'll buy 2 or 3 other properties and leverage up to the knees.
Yep. So, okay, simple stuff. Capital gains are generated by selling the asset. You can downsize, but this may require making some sacrifices like smaller properties or different locations. Old people like us don't like doing that, right?
Don't like to sacrifice.
Yeah.
You boomers.
Bugger that, we're travelling, right? Think of your personal position, right? Remember we talked about risk initially, right? What's your market knowledge? What's your fundamental financial position? What's your personality, right? What's your time frame? What's the asset's liquidity, right? With stocks, you can sell it in a click. Doesn't mean you're going to get the price you want. Property, you can't sell it a click. And if the market turns, people start knocking hundreds of thousands off it real quick, right? Remember valuation and the expected returns, right? Okay, so this is a sort of a summation.
I'm going to say it. It's hot to think about investing.
Right, yeah. Yeah, I didn't notice that actually.
Nice typo there.
Oh, okay, yeah. How? Righto, at least you're paying attention. Righto, how to think about it. What's the investment's base rate over your holding period? Right? So let's use stocks. Okay, if you said, Steve, I want to do it for 20 years, I'd say, all right, Jacob, look at the spread. Sometimes you earned 20 and annual, and sometimes you earn 2. Oh, okay. Well, how come, Steve, sometimes I earn 2 and sometimes I earn 20? Good question, Jacob. Look at the valuation. Oh, when it's really low, I earn 20, and when it's really high, I earn 2. Okay, now go and look at today's valuation, right? Okay, I'm more like going to be earning 2. Okay, maybe you want to hold off.
Yeah.
Okay. Remember the earnings yield. Okay, if you're going to earn 2, you really want to hope that the capital gain is going to be amazing, right? Because you know the long-term rate is 8. Okay, so if I'm getting 2, that means the stock market price is really, really high.
Yeah, is the investment's expected return higher or lower than the base rate?
Yes.
So keep that in the back of your mind.
Yes. Okay, ask yourself, do I have information that will raise the probability that this investment will be positive? Okay, I got a secret source that the market's expensive, but energy stocks are really, really cheap, and I'm determined to hold them for a decade, and I've got an asset allocation and rebalancing plan. Oh, okay, cool.
Cool, go for it.
Yeah, they're earning 12%. Warren Buffett's buying Occidental Petroleum. All right, sounds like a good idea. Okay. Are you relying on capital growth or capital gains rather than income for the bulk of the return? That's property.
Yeah.
Right? Listen, Steve, I'm losing money every week. I'm writing that off on my tax. You're still losing money. And I'm hoping for a big fat windfall. Right? Okay. If so, you should be aware of the cycle and have a selling date. Okay? Again, if the long-term average of property is like 2 to 3% and you've made 10, 15, 20, 25, you might want to have a think about how long that's going to last.
Don't be so bloody greedy.
Right? The dividend rental yield will be lower due to a high purchase price. Okay? Pretty straightforward. Okay. What are the assets' current income stream as a percentage of the personal purchase price? What's the dividend yield? What's the rental yield? Right? What's the asset's expected capital growth? Okay, as I said with Perth, do you think it'll go up 20% per year every year? No. Okay, well, that's good. What do you think it'll be? I don't know. Okay, we'll use the long-term average, which is 3, right? That's the way it works. Now, you can say, oh, mate, that's a bit ridiculous. And it's like, okay, but that might look ridiculous for the next 2 or 3 years, but if you want to hold it for 20, you're best off using 3.
It's ridiculous until you actually just do the math, the calculation.
Yes.
This is not just a number that someone's making up.
Yes. Yep. Okay, let's go.
Next one.
The next one. Righto. What's the payoff? Hopefully I've spelt that correctly. Yes, I have. Right. Can the asset generate higher returns through dividends, rent, or capital growth? Right. In other words, I bought it because Grandma sold it to me really cheap and it's got a really big yield, 10% rental yield, or I'm buying it and I think there's a lot of capital gain here because everybody's vomiting about property, so therefore it's a good time to buy.
Yes.
Okay, like stocks. Okay, then determine what you can do. Can you dividend reinvest program with property? So like stocks, if they send you a check for $1,000, you can say to them, no, I want to reinvest it in the company, don't send it to me.
Yeah.
Okay. Can you reinvest without more leverage? Okay. Lots of people in property investing borrow $1 million, make money, but then borrow more, right? So they get to the point where they owe $3 million, but their property's worth 3.6, but then the property falls and you go, holy bugger, now we're on the hook for $3 million.
Oh, it's like being margin call.
Yes. Same thing, right? What are the arguments for increasing the fundamental components for increased future returns? Jacob, the rental yield's going up because everybody's homeless and the government's going to pay me to house them, right? Jacob, the capital gain is going to rise because I know they're building a shopping centre close by with a street and lovely schools and the place is booming. Right? Okay. The point is, what do you do with the earnings? Okay. So in companies, they can reinvest it to generate future income generated by productivity. Okay? So this is the argument about, if I give the company my dividends, they say, Jacob, we can compound this at 20%. This is Warren Buffett, right?
Yeah.
Why should I give you, Jacob, my dividends, your dividends, when I can compound it for you at 20%? Just leave it with me, right? That's Buffett's argument. The thing we talk about with property is buying existing property is not productive. All you're doing is paying more for an asset, okay? In property, can you reinvest the rental income for greater growth, or raise the rent higher than the inflation rate? Okay?
To a point, you can raise the rent to a point.
Yeah. Well, you can raise the rent. It's just whether you get a tenant that pays it.
Exactly,
right?
yeah.
But also, too, this is what we were talking about before in the last episode. I think inflation's going to stay high for a while. That's going to reduce your returns, right? And that's why we sort of talked about being a little bit more nimble and dynamic in all markets, property, stock, gold, whatever, because inflation's going to eat away your return. Therefore, you need to be a little bit quicker in taking the capital gain to capture it. Now, that then means you've got to pay tax and stuff like that. So that's where investing gets a little bit trickier. But what we've tried to do over this series is give people a really fundamental framework about investing, right?
So it doesn't matter what you're looking to invest in, you should have 4 or 5 questions to ask now. I mean, even some numbers to plot into a spreadsheet to work out property yield as well. So I think it's important. Is there anything else?
No, that's about it. I think there's
a Buffett quote at the end.
Of course. How could we not end with a Buffett quote?
Let me read it. For the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favourable business developments.
Okay, that's what we're saying. Price versus value. You can pay for a really great property, a really great stock, but if you pay too high a price to the yield, you're not going to turn it around. You're not going to get miracles. Well, you might get one in a zillion, where some idiot comes along and gives you double the price. And my advice is take it, right? But you've got to understand that price value equation, and you've got to be honest and say, okay, it doesn't look attractive. What do I know that makes it look attractive, right? Oh, well, everyone's investing in property. It's like, that doesn't make it attractive, right? Yeah. It might make it attractive for 2 or 3 years if you're planning to flip it.
Oh, it makes it terrifying for someone like me.
Yeah. Well, a lot of people, you see property prices, they say bought it for $1 million, selling it for 900, but then you got stamp duty and, you look at it and go, wow, and it's the same in stocks. You buy it for $1 and you end up selling it for 80 cents and you go, oh man, I just wore a 20% loss, right? And you've got to try and make that up elsewhere. Yeah,
it's a lot of different decisions to make, particularly in stocks as well.
Absolutely.
All right, well, we'll leave it there. Hopefully that's helped listeners understand kind of what we ask ourselves when we look to buy something or anything. But if you have any questions, as always, we're open to answering them through the socials or just on email. Send it through. Thanks, Steve. Till next time.
No problem. Thanks, man. Cheers, folks.
As always, remember, we don't provide financial advice.